Hey, how's it going today? Dustin Tibbetts, financial advisor here with Jazz Wealth Managers. We're financial advisors. We manage expense-free portfolios for customers. You can see them all on our website. And what was it, about a week ago on our live show, we call it The Closing Beat. It's a daily stock market update show that we do on our YouTube channel. It's live every day at 5 o'clock Eastern time. We were talking about the idea of maybe doing some videos that had to do with building portfolios. Do you like the idea of building your own portfolios? And if so, how would you want to go about it? See, the thing is, there's always going to be people that say, I need help from people like Jazz Wealth. Great. Hopefully you keep us in mind and you come check us out. We manage long-term investments, retirement investments. We do all the work for you, in addition to education and all this other stuff. But there's also going to be people that say, I like this. This is fun. I want to do this myself. I don't want to pay somebody to do it. Maybe you just like the idea of handling your own investments, and that's awesome. I sort of equate it to people that will sort of maintain their pool or their lawn or something. There's always people that will find some kind of joy in doing that, or maybe they want to save the money. Totally okay with me, but I don't want to leave those people out. And so I got a lot of comments from people saying, yeah, tell us how to build a portfolio, Dustin. Let's see what you can do. Well, we're going to do a series of videos on these, and we've reached sort of an interesting point in history where you now can do this. You don't anymore need a mutual fund or an ETF, right? Because last week and the week before, Schwab, TD Ameritrade, Fidelity, E-Trade, Interactive Brokers, they all cut their commissions, meaning there's no cost to buy a stock. There's no cost to buy an ETF. But to hold the ETF has a cost. Granted, it's very little, nobody really cares. But still, if you're a person that says, I want to eliminate all costs, you can now go build your own portfolio of stocks or whatever you want to put in there, right? So we're going to focus on different types of topics here as we do this. Today's topic is going to be based on stress. We're going to build a hypothetical portfolio here, and then we're going to try to help you eliminate the stress or the volatility of that portfolio. See, it's one thing to pick a bunch of growth stocks, right? And maybe you can handle the daily back and forth. You don't mind. But if you're used to holding a mutual fund, you're counting on the person managing that fund or the funds we have at our website. You're counting on us to give you the best return for the least amount of volatility. You don't want to see your account fluctuating back and forth a lot, or at least fund managers don't want you to see that because then you call and you're like, yo, what's up? So they try to give you the best returns with the least amount of volatility, really, so you don't bug them or go choose a different fund. So as managers here of our own funds, we never had trading commissions, so we could build our own portfolios, and that was always our goal and will continue to be our goal. The best return for the least amount of volatility or stress, we're calling it today. So let's dive in. Let's go through a hypothetical sort of setup here. I want to start by just letting you know this is in no way a suggestion of stocks that you should buy or anything like that. I have to say that, this is just an example, right? That's all we're doing here, just giving you a quick example of how things work. So we put together a quick little portfolio. On the left, you can see all the stocks. You got S&P Global, Texas Instruments, Bookings. I just threw a bunch of names in there that maybe people would consider a growth stock or has been a growth stock, something like that. Don't bug me because I left something out. I just threw a bunch of symbols together. Seriously, it was just a total random shot in the dark. So what we have here is the stress relative to the returns, right? So here's the returns over the last 10 years annualized, and then here is the back and forth of the stock. That's just the easiest way to say it. How much was the difference between the lowest point and the highest point of the stock for a given period so that you know which ones are more wiggly than others, to use really simple terms there? And so we put together a little portfolio. Now, your job when you build a portfolio is to eliminate the stress, right? And so what I did is I put all this on a little scatter plot so you could see. We'll go over to that part. And here's all these different stocks. Now, don't let this scare you. What we have here is as you move further to the right, the returns get better. As you move further higher, they get more volatile. So for example, you could see like Celgene, right? Good return, but it's really volatile. Down here, you've got these stocks that have the same return, but are less volatile. And here's about the average, right? Look at two that stand out. Booking Holdings is booking.com. So really great return, 28% there, looking good. You're excited to have that one in your portfolio, but it's super volatile, meaning it's going back and forth a lot. And I'll show you on a chart. Stick with me here. I'll show you at the end. You have something down here like S&P Global that's giving you the same returns, or at least as of now, giving you the same returns with a whole lot less back and forth. It's your job now to eliminate the stress from your portfolio. We've all been there, right? You've been there, where you buy a stock, maybe you buy a bunch of stocks, one does really well and flies off the charts, and the other one is scaring you half to death because one day it's down 10%, next day it's up 10%, something like that. So what we want to do now is find ways to get the same performance out of, let's say this is the group that we have to deal with, but we want to eliminate these stocks here. Vertex, Celgene, Booking Holdings. We want to find a way to eliminate that stress, okay? So when you're building your portfolio, think stress. Now I'm going to try to pop over to, bear with me for just a second. I'm going to try to find a way to just sneak on over to another little area here. I want you guys to see what this looks like on a chart. Because if you don't follow me so far and you're like, that was a lot of geeky stuff, dude. I don't know what you're talking about there. That's kind of weird. Just show me something else. Let's take a look at the performance. Now I'm just pulling this up here, so work with me here. On the chart, these are those two stocks. In purple, we've got S&P Global, and in orange, we've got Booking Holdings. And what we're going to do is just zoom out. We're going to go back 10 years and look at the performance of both stocks. Now, at first glance, you say, okay, I like this one. I'll take that Booking Holdings. That's great. We take the annualized returns. It matches up exactly to what we have on the spreadsheet there. Here's the annualized returns. So you go, all right, if I had to build a portfolio with one or the other of these stocks, which one am I going to choose? Your first thought is always performance. I want the best growth possible. However, look very carefully at what's going on here. Here's Booking Holdings in orange. Look at how much it goes back and forth as it generates those returns. Some of you, going to be totally okay. You're fine with that. You don't mind the back and forth. It's not going to bother you. But look how much smoother S&P Global is. Yeah, it has moments of volatility, but in general, it's plugging along doing well. Would you rather have 50 of these in your portfolio or 50 of these, right? Now, that's the magic sauce. I'm not by any means suggesting you're going to be able to find all of these. It's obviously very difficult. But when you're building a portfolio, you have to be able to go through and eliminate some of the stress. There's no need for taking more stress in a portfolio than is necessary. See, the stock market's a little bit different where you do not get rewarded on a linear curve, a linear straight line, really, for taking more risk. Meaning, you can take more risk and expect more returns up to a certain point. After a certain point, the more risk you take is only generating a minuscule amount of extra returns. So there's no real sense in taking that extra risk for such a small difference in returns, right? It's just adding more stress for no real reason. So at the end of the day, most people would say, I'll take a tiny bit less in terms of performance if it means a smoother ride along the way. When we hit a recession, when we hit some big downturn or something, it means that you don't ride along this really bumpy trail on the way down, right? So some of you may give me some grief there. I know I tried to oversimplify this, but it's just to try to explain to some of the beginners out there how you can build a portfolio now for free. Right? What I just showed you on the previous screen there, you could actually build the whole thing now with no commissions. And stocks don't have a carrying cost. They don't have an expense ratio. They may pay a little dividend or something, but they don't have a carrying cost. So in general, you could build a portfolio just like we have on our website and not pay a penny anymore. That's huge, but be very, very careful here that you don't load up with too much volatility because you will scare yourself out of your own position. So you want to be able to see the data so that you know you're going to be able to weather the storm when they eventually do come. They will. And so you know exactly what you're dealing with. Let me know what you think about this one. I'm trying to test out some different videos here in terms of showing portfolios and how they're built, but using data rather than just being another guy on YouTube that tries to tell you how to build a portfolio. I want to actually show you some of that data. So we'll put together all the geeky stuff that we need to get you there if you like this sort of thing. Also, if you like this sort of thing, obligatory request to hit the subscribe button, the thumbs up button. Let us know you're there. Let me know that this is something you care about. Or if you don't like it, let me know you don't like it as well. We can move on, of course, and focus on things that maybe you do like a little bit more. I'm always trying to make you guys happy here. We'll see you later. 5 o'clock is our live show, The Closing Beat, like I mentioned earlier. I hope to see you there. Enjoy the rest of your day, and we'll talk to you soon.
Why should you choose Jazz Wealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interest comes before ours.